Welcome everyone for our wealth management review for Daniel Krug and Associates on May 13th, 2021. Today's presentation is titled Strong Growth and Can It Continue? My name is Rocky Istvan. I'm the Chief Compliance Officer and Associate Wealth Manager here at Daniel Krug and Associates. Daniel Krug, CEO and Senior Wealth Manager, will be joining me in this presentation. Just a reminder that this presentation is for informational and illustrative purposes only. It is not a solicitation and should not be considered investment or tax advice. If you have any questions regarding anything we're presenting, give Dan or myself a call in the office, and we will walk through those questions with you and how it relates to you personally. Today's presentation is going to be right around 25 to 30 minutes. We will leave time for some Q&A at the end. This session is being recorded, so we will be able to replay it later. Everyone will be muted, but like I said before, you can use the chat room on the right side of your screen to type in questions, and we will get to those near the end. Again, we want to thank CNR and AssetMark for their contributions for today's research and slides that are being presented. Just a reminder, at Daniel Krug and Associates, what wealth management means to us. And of course, investment consulting, the top half of this chart, is very, very important. You know, we have many investment solutions. We have cash and banking solutions. We provide trust services. But where we really find that we can help people and bring that added value to your estate plan and your financial plan is through our advanced planning strategies. And those areas are in wealth enhancement, wealth transfer, wealth protection, and charitable giving. So you get with us and we can really optimize what you're trying to do for your family and your future. So today's agenda, we're going to go over some of the latest developments and trends, just an overview of those. We're going to look at what's going on currently in the markets and the economy. Then we're going to take a few minutes to talk about where we see things going for the rest of the year and have a little time for Q&A at the end. So before we get started, I'm going to stop the presentation and bring Dan and myself online. Hi. So we can see you guys. Welcome, everybody. Good to see you. Glad you can join us.
Yes, I'm ready for, hey, I think this is going to be a relatively quick one today. So you guys are going to have time to get outside and watch some birds fly. I don't know. It's pretty sunny. It's spring. It's nice outside right now. Yeah. So let's go ahead and get going on this thing here. And I'm going to start the presentation off with the latest developments and trends. The major changes, the major influences that are going on right now. And really from last quarter and the beginning of Q2 here is first, we have the majority of the higher risk age groups in US have been vaccinated. And that's a big deal because if you think about the high risk group, that's the 65 years and older, the majority of that group, I think it's over 80% at this point, have been vaccinated. And that comes into the next bullet point here, which is the US hospitalizations of older age groups have fallen significantly. And so too has the mortality. So very good news then for that area. And we're looking at that trend improving as we continue on. In Q1, we've had very strong economic growth, and it does seem to be continuing through Q2 as we're moving into it. Inflation, you know, people talk about inflation, but the inflation is increasing near term. However, it is expected to moderate longer term. So no real fears, and we'll talk a little bit more about inflation throughout this presentation. And Fed policy continues to signal low interest as well. And again, we'll bring out some more data on that. Another interesting fact out there is the company stock buyback programs is in full swing in Q2. What does that mean? It means that companies are feeling very bullish about the market, so much so that they're willing to buy back their stock, basically let it grow within them to have it for a rainy day. So that's a very positive trend moving forward. Now, current markets and the economy. The 2021 returns. Now, this chart here really shows two separate time frames. On the left-hand side, you've got April's returns, and on the right-hand side, you've got year-to-date returns. And as you can see in April, U.S. equities were really pushing forward and leading the way. And then you had international equities and emerging markets. But when you look at the bond part of the portfolios in April, it actually had a bit of a comeback from what you could see year to date. The year to date numbers for US bonds, international, and emerging market are still negative. However, we're seeing a trend up in April. So hopefully that's going to continue on here in May. But the interesting thing when you look at the equities really pushing forward year to date, especially the U.S. equities up 11.8%, that is largely due to the fact that the bonds have been retracing. If you can't get a good enough return in bonds, people are going to go for additional risk, and that's another thing driving the equities market. Now, let's take a look at sector returns versus globally balanced portfolios. And in this case, we're looking at a 60% global equities against a 40% bond portfolio. And again, we've got this slide broken up into two time frames. April on the left and year to date is on the right. April, again, was a very, very strong month where if you were really diversified in a global equity portfolio with bonds, you were up about 3.2%. If you look at strictly global equities, they were up 4.4 and global bonds 1.3. Now, what was really pushing high in April is the U.S. REITs and commodities. And you can see in April, bonds kind of held its own with the 60-40 portfolio. Now, let's go over again to the year-to-date side. You can see that the global blend of 60-40 is up 4.3, and the global equities kind of moved up even higher, 9.3 year-to-date. But you can also see the bonds globally have dropped. They're down 3.3% year-to-date. And then again, U.S. equities and commodities, or U.S. REITs and commodities, are really the leaders. And you could kind of understand that when you look back last year, U.S. REITs, real estate as a whole, commodities, they were having a really tough time a year ago. So you can see how it's kind of bouncing back. The interesting thing, people would say, you know what, should I be getting into gold? Should I get a lot of gold? Our answer to that is, how much volatility do you like? When you look at the gold prices, it's down about 7.1% year to date. I don't know, I would rather be in a global portfolio and have a little bit of gold in there and be up 4.3. It just stabilizes when you have more diversification in the portfolio. And that's kind of a theme we'll be talking about through this presentation. I love this chart because what it does is it kind of reflects on the markets a year after this major downturn we had back in February, March of last year. So the way this chart works is in the dark blue, you've got the drawdown of the four different sectors here. So from January 1st to March 23rd, when we had the major drawdown occur. If you look at U.S. equities and international and emerging markets, they were all down in the low 30s for that drawdown. And you can see U.S. small cap was down a bit more than that at 40%. Now, let's fast forward through the recovery from March of 24, 20 to March 21st, 21. And you can see that each one of these areas have really bounced back tremendously. It's like they hit the bottom and they didn't want to look back. So the one that stands out the most, however, really is your U.S. small cap stocks. Even though it was down more than the others, it was up considerably higher than the other three sectors. The light blue bar at the top that has the percents and the circles in it with the percentage, that really is the total return for each one of those sectors. And again, you can see U.S. small caps really boomed. And it's interesting because you really can't just bounce around from one sector to another trying to chase returns. What I find interesting is the U.S. large cap has really done well for the last few years. U.S. small cap, on the other hand, had a couple slow years relative to U.S. large, but look how much it came back. So if you would have pulled out of U.S. small caps and gone into large, you really would have missed a huge uptick within your portfolio. So diversification, again, is the key, and really stay in the course. The strong recovery that has been pushing along is continuing. This chart here really talks about high frequency economic indicators. Now, what's a high frequency economic indicator? It is things that are used literally on a daily basis. So you think about credit and debit card spending, that's done daily. Mobility, in other words, moving around, that's daily. Restaurant reservations, same thing. And what we found really over the last 2 months is we've had a surge back up again, and we believe it's going to continue to move that direction. So things are, again, looking well in the U.S. from a recovery standpoint based on the pre-pandemic. Now, let's go a little bit more globally. Let's go across the pond here. The virus troubles, when you look at the U.S. versus Europe, well, there's a little bit of a dichotomy going on here. Initially, when we had the pandemic, you saw both of the two areas drop dramatically, and bounce back. But what you are finding now is there is a resurgence in Europe. They're closing back up again, and there's a couple of things that are happening. One is they are struggling with getting everybody vaccinated. And also, or in conjunction to that, there's a lot of shutdown restrictions, which is really impacting the economic growth in the Eurozone. But in the U.S., different story. If you think about the U.S., you've got some states like Michigan that are still pretty much closed up, but you've got other states, South Dakota, North Dakota, Florida, that are really opening up, and they're kind of offsetting states like Michigan that are still closed down. So all in all, the U.S. is moving forward nicely, and we're expecting it to continue throughout this year. Now, what about inflation? You hear about inflation, is inflation really coming, and how fast is it going to get here? Well, I think many of you know that the way the Fed kind of measures inflation is they have a basket of goods, like bread and gas and, things that you use on a daily basis, and they put it in the basket and they look at the cost of that on a month-to-month basis. And what the Fed would like to do is maintain about a 2% target for inflation. And in this graph, you can see the aqua line, the Fed's 2% target, and you can see the black line, which effectively shows how it's been up and down over the years. Now, the one thing I'd like to point out is when you look at 2020, the inflation actually dropped down to about 0.5%, so 0.5%. And people talk about, well, inflation is coming, and we're seeing a lot of it right now, but in February, we were still only at 1.6%. So even though it was a 1.1% increase, we're still well below the Fed's 2% target rate. And if you look at that dotted line at 2021, and you look at the purple required 3-year average, that 2.4% represents how high the interest rates would have to go over the 3-year average to make us, just to bring us back to the 2% mark. So inflation right now is not really a problem. And there is kind of, I guess we've all now heard of the K recovery. There's kind of a K recovery going on with inflation too. If you think about it, with the different types of goods out there, you know, you think about construction. Do you think inflation is in construction right now? Big time, yeah, really big time. But when you go to other things like travel, the cost of travel is less right now. Rentals are down. Vacation stuff is down. So we've got kind of a K recovery going on with the inflation rates as well. And that's what's keeping it so low. Some areas are high, some areas are low. It'll balance itself out as the Fed works its strategy. Now, speaking of inflation, how does unemployment play into inflation? Well, if you think about it, employment or wages is one of the big drivers in inflation, right? And it's difficult for people who are either unemployed or are thankful that they're employed to be asking for raises, regardless of whether they feel they deserve it or not. They know that it's kind of a precarious environment out there. So the wages aren't moving up a whole lot right now. And part of that reason is because the unemployment rate is so high still. When you look at this chart, it runs from the beginning of last year to February of this year. And you can see in the beginning of last year, unemployment was just phenomenal. You know, if you were in the restaurant industry, which in my prior life, I worked in the restaurant industry, I really didn't like it when unemployment got that low because it was very difficult to get good help. Well, you fast forward to the pandemic and the unemployment rate jumped up to 14.8. Well, that's a huge spike. And obviously it's because we shut down the country. As time went on and as the vaccine was being produced and the states were opening back up, you could see unemployment was coming down pretty fast, pretty sharply. And then right around the election, it's kind of stabilized a little bit. So we haven't made a whole lot of progress since then. Part of the problem is you've got a resurgence in the virus in some areas. Others is that states just haven't opened up to allow the employment to take place. And then the third aspect, which is a huge one, if you've talked to a business owner, they are so frustrated trying to get help right now because, well, we're paying people more to stay home than they are to work. So at some point, the government has got to figure this out and allow people to go back to work to get this economy back to full steam again. But they'll do it. They'll figure it out. You know, sometimes they're just a little slow. But, you know, when you think about inflation, I wouldn't really worry about it right now. Will it come down the road? Who knows? It could be 5-6 years down the road before we see anything. But as of right now, it's looking pretty good. So that said, I am going to bring Rocky on. And any thoughts on those charts?
Yeah, that actually looks like both of us on.
Oh, yeah, well, yeah, both are.
I think that two things that came to my mind going through those charts, because everything looked like it bounced back so fast.
Yeah.
Again, it's due to the fiscal stimulus.
That's a big part.
The government pumped a lot of money into the system. And then the other side is what's not talked about a lot is the Fed buying program, where they actually went in and bought bonds.
Yeah, yep.
And they started to prop up the bond fixed income side of the economy by underwriting those bonds so those companies wouldn't default. And that's why you see that huge spike in small companies, because traditionally, the big companies sometimes can ride through a recession, but the small companies get hurt really bad. But when the government came in and started giving the loans to small businesses, they started buying the bonds of companies that said, hey, those companies aren't probably going to go out of business. They might ride through this, and thus the stock values maintained and came back pretty quick. So when we talk about inflation moving forward, one of the things you have to remember is the Fed doesn't have to necessarily raise interest rates right away. What they're going to do first is unwind the buying program.
Yeah.
They're going to start easing off of that and selling bonds back into the open market. So that's something that you've got to watch before you actually see them start raising interest rates. But that's all signs that the economy has got a good foothold, and they believe it's moving forward.
Good point.
So just kind of a couple points on that before we move on. So now I'm going to bring us back to where...
Bring us back.
Back to where we kind of see things going, looking forward through the rest of the year. I'm going to start with a couple of key sectors or key indicators that we look at and where we see the strength. I mean, we're looking at the strongest economic growth that we've seen in almost 40 years. And it's due to the way that the fiscal stimulus came in and supported the shutdown and got us restarted. The strength's going to basically come from three sectors in the economy. It's going to come from consumer spending, which we're going to look at here, housing, and manufacturing. So let's start with retail sales here. And you can see at the right side of the chart, the huge dip when they shut down the economy. You couldn't spend money because nothing was open. But how fast that black line came back up, and actually we are ahead of the trajectory we were on in retail sales. So that's a positive. So not only were companies allowed to remain open, but people had money to spend. Some of it came from the stimulus.
I think a lot of it came from the stimulus.
It definitely did. So that helped support retail sales. I think another thing that played really well into here, if you go back 20 years ago, who was buying things online?
Not me.
Yeah, no, hardly anybody. 10 years ago, not even a lot of people.
Right.
But over the last 10 years, the Amazon, the online shopping, the eBays, those companies, the ability to buy something online, have it delivered to your house, allowed you to go and spend money even though stores were closed.
Yep.
So it was an interesting time that we were going through, and you could see it here in the recovery in retail sales, and we project that to continue to be strong. Building permits. I believe everybody out there by now knows how hot the housing market is around the country. Even in Michigan, we're seeing it. How there's not enough supply out there for the demand, and new building permits is what this is measuring. If you look at the very right side of the chart, we are way up there over the average and basically maintaining a strong market for new homes. That is great for the economy because home building is such a big part of the whole economy, right from the supplies of material through the labor needed, all the way through. So we're seeing a continued strong housing market as it relates to new permits coming into the building sector. Also, manufacturing. Again, on the very right side of the chart, looking at what's happened from 2020 to 2021, we are way above the average in manufacturing recovery. Why is manufacturing so high? Because people have the money to spend and they could buy things online as opposed to have to go to a store when the economy was closed. So very strong continued growth in manufacturing through March, as you can see here. So
now, if they could just manufacture the chips for the cars, they could probably sell the cars that are sitting in the lots waiting for the chips.
Yeah, and that's actually part of what's keeping, I think, inflation down, because when you shut the economy down, there's such disruption in the supply chain.
There is.
And we don't have a smooth supply chain yet. So this is going to be up and down for a while, but the opportunity for growth is out there, and they're going to fix those things as we move forward. So again, talking about where we see inflation going here in the rest of the year. Short term, the red line is showing you what we believe is going to happen. This is a year over year change in inflation. And you can actually see, looking at that blue line on the left side of the chart, how it kind of looked like it was actually going down in 18 and 19. But then in 2020, we had the drop due to COVID and things shutting down, an immediate bounce back, and then a leveling off. But now that we've got the vaccine, now that a high percentage of people are getting or have been vaccinated, and there's also more herd immunity out there than there was obviously a year ago, as more people have recovered from COVID and now have the antibodies, the demand is going to stay stronger than the supply because of the disruptions in the supply chains. So we expect that to cause a short-term, pretty significant increase in inflation. However, we don't believe that's going to continue for the long term, because once the supply chains get filled back up, we think things are going to moderate. But expect it, for the next half of the year, that we're going to see a little increase in inflation moving forward. Another thing we look at, and I apologize, these are very unattractive charts, but they tell the story, and this is how our analysts are looking at it. When you look at this one, the black dotted line represents the 30-year average of the consumption rate in the United States and how they measure inflation. It's been an average of around 1.9%. Okay, that's the black dotted line in the chart. You look at where we're at right now, is 1.6 is the blue dotted line, the 3 dots there. We're actually still way under the Fed target. And as Dan said before, you actually have to have higher inflation than average to somehow settle back into an average. So we're going to see that short-term spike way above, 3.5% inflation increase here in the second half of the year, but we believe it will moderate. And remember that the stock market is always forward-looking, so it's pricing in this inflation right now.
Yeah.
So it's not like we're going to expect a huge change in the stock values over the long term. Yes, short-term volatility, because inflation, you're going to hear inflation numbers that are going up. So expect the volatility on the daily basis, but we still believe long-term, things are moving forward and we see the economic growth. So we went through 3 of the sectors of leading economic indicators. This is our chart that we show of all the speed dials, the 20 different areas that we look at to determine if we're moving forward, if the economy is expanding, looking forward, or we see some places where there's got some negatives. And if you remember us showing this chart before, a year ago, we had a lot of red on this chart. And again, how you read this chart is if it's green or green-blue dials, that means it's a positive trend. If it's yellow, that means it's kind of neutral, not necessarily moving forward or backwards, but maintaining. And then obviously red would be negative, but there's no red on this chart. And that's just amazing how strong the indicators are signaling that we have an even more entrenched and durable recovery coming out of the COVID crisis. So we believe that this is signaling the second half of 2021 is going to continue to be strong for the markets and the economy moving forward. And I want to go over kind of how we measure the gross domestic product, GDP, and what we see from a forecast standpoint. We're still right on target from what we've been showing earlier in the year. If you look at the middle of the chart here, the middle of the slide, the potential GDP growth range, look how bad it was in Q2 of last year. We were down 31%. However, due to stimulus and being able to do online shopping and things like that, Q3, we had a great bounce back of 33%. Q4 moderated to about 4%. And the Q1 of this year, very strong, we believe is going to come in somewhere between 4 to 6%. However, when you look at the right side of that line, the annualized 2020 growth of the economy actually stayed negative because it was such a hard shutdown. But look what we're forecasting for this year and next year. We're going to be somewhere between 5 and 6.5% in growth in the gross domestic product or the production output of the United States. And we still see it strong in 2022, somewhere between 2.5% and 4.5%. So if you think traditionally, Dan, over the last 30, 40 years, a 2.5% growth rate would have been considered a fairly strong market and economy that gave us a 6 to 7% annualized rate of return on a 60-40 portfolio. It did very well. So we see that for the future. However, there is going to be volatility due to disruptions in supply chains and rising interest rates as a result of demand exceeding supply in the short term. And I'm going to wrap up with this. So what do we think is going to the market's going to look like towards the end of the year? Well, based off of what we're seeing at the end of April, we're forecasting U.S. growth to moderate, because it's above 10% right now, to moderate and be somewhere between a 6 to 10% annualized growth rate. Dividend income stocks, your value stocks versus growth stocks, same thing. They've come back really strong this year versus growth. They were a little bit behind. Here again, mid cap and small cap stocks has a little bit higher opportunity, again, because they didn't go out of, as many didn't go out of business in the shutdown because the government helped prop them up. We see strong recovery and continued growth in the small and mid cap range. The negatives we see, as Dan alluded to earlier, is the developed markets. Again, they're having issues with COVID, much greater than we are, and they didn't put the stimulus that the United States, the monetary policy didn't act as fast as our government. So they're not seeing the economic turnaround as fast as we are. However, emerging markets in Asia, we expect to see strong growth, and it's not really kicked in a whole lot yet, but we believe in the second half of the year, as the U.S. economy recovers, they're going to be coming back gangbusters in the second half of this year. The middle of the chart, taxable and tax-exempt core fixed income, is still going to continue to be negative. And even though it's coming back, these numbers were down in double digits. We expect them to end down about 1 to 2%. And you're saying, well, then why would I have a mixed portfolio of stocks and bonds? Because what we do is continue over to the right, look at the opportunistic fixed income. In the tactical area of corporate bonds, high yield bonds, things like that, we're expecting to have a high rate of return of 5 to 7% in those areas. So we shift a little bit away, we underweight core fixed income and overweight opportunistic fixed income in your portfolio on the bond side. And then also, you have to have the alternatives in there. You saw that how gold was down, but it was showing signs of coming back. Commodities, same thing. Commodities are going to be strong as a result of the short supply, lumber, corn, things like that. Still, the supply chain disruption is causing those to have to ramp up. And so we see opportunity in growing there until that supply chain gets filled back up and we're more normalized in our growth. And how does that equate to the balanced portfolio all the way on the right? We're looking at a gross rate of return of somewhere between 6 to 8%. So I do not see that as a bad year at all. But do remember, we keep saying volatility is here because of disruptions in the supply chain. So you're going to hear, oh, this is a shortage, or you're going to hear the raising interest rates. Those things are going to go on, but always take the long view when looking at your portfolio. And we see that light at the end of the tunnel, and we're planning for that moving forward. So that's kind of my stuff, my area, and I'm going to bring Dan back on. We're going to talk about the opportunities and wrap things up. So
absolutely.
Any other points on that, Dan?
Well, it's just when you're looking at the market today and you look at where the growth is, and I can't stress this enough for people who are long-term investors. You just can't bounce around from one place to another trying to chase the returns. You've got to be very strategic in what you do. And you've got to be methodical, and you've got to be patient. Patience is really, I mean, they say patience is a virtue. Well, in investing, it is critical, because if you can stay the course, you will get the returns that you're looking for. Yeah. And we're seeing that with clients today. Yeah. Was there a little bit of volatility in the last couple of years? Absolutely. But do the returns reflect a very solid, on-target, goal-oriented return? Absolutely, and people are getting exactly where they want to go. So it's diversification, like you said, and it's just staying the course. So I see a lot of good things for 2021, and it's like we say, it's short of another black swan. Yeah, 2022 should be pretty nice too, from a stock market standpoint and market as a whole. So we'll continue to keep an eye on that. Rocky talked about opportunities out there. The reality is, relative to opportunities, the market's always going to give you opportunities, whether it's opportunities to gain more in markets, or opportunities when markets come down to do things like Roth conversions. Basically, you're converting either more money, but you're doing it at a discounted stock market rate and able to bounce right back up, and that all comes back tax-free. So it's all about strategies when you're looking at the overall portfolios, whether it's investing or the advanced strategies, to really kind of eke out more net return for the client.
Yep. So we're constantly managing that.
Well, yeah, I say it all the time. We're a tactical firm in everything that we do, whether it's investing in the market, whether it's tax planning, estate planning, risk management. Think of it like a 3-level chess game, or in this case, a 4-level chess game. You're always having to watch what the other side is doing to move things around, and then adjust accordingly and very tactically to gain a much better long-term net rate of return for yourself. Yeah. So that's really what we're looking at. So let's kind of round this thing up, and let's talk a little bit about the opportunities. I mean, I said a little bit about it already, but from a planning standpoint, if the market goes up, if the market sells off, is it that big a deal? No, the market's going to do that. It's only a problem if you don't have a plan, and we always have a plan. This chart here, and this kind of wraps up the reason diversification is important, especially if you don't like a lot of volatility. This is a diversification chart. What it shows you is multiple asset class, from growth at the top to international dividends on the bottom when you're looking at the right-hand side of this chart. When you look at the maze there of different colors, you really don't see any kind of consistency. But the way this chart works, it says that the sectors that have done the best rise to the top in any given year, and the sectors that do the worst go to the bottom from a return standpoint. And again, as you can see, there's not a lot of reason and rhyme sometimes as to which portfolio or which sectors are going to do well one year. You certainly can't look at the previous year and say, well, you know what, in 2018, the growth stocks did well, so I'm going to jump into that. Well, what happened in 12 of 2018? Well, it dropped down to negative 15%, almost negative 16, and then it bounced back up again. So you can't jump from area to area, but you can be strategic. Now, the other thing that you're looking at with this chart, again, the growth chart has that dark red line, and you can see the volatility in returns from one year to the other. But going back to that global portfolio, that's blend of 60-40, 60 equities, 40 bonds, and that's represented by the thin red line, you can see there's a lot more stability there. So if you're a high risk taker, we might get you more aggressive. You might have more growth, and that would create more volatility. But if your risk level is low, you really need to be more globally invested and have bonds associated with it to kind of smooth the ride out a little bit. Which really brings us to questions, Rocky.
Yeah, we'll take a check here, but looks like we don't have any questions at the moment. If you want to quickly try to type something in there, we'll hold on for a minute here and see if there's any questions out there. We really do appreciate and enjoy having you guys on for these presentations. We do like doing them. We're not technologically savvy sometimes in doing them.
Yeah.
And speaking of that, we are going to make a change in our software.
Yeah, we are.
Presenting.
And you may not notice the difference. Maybe you will. We're currently using Webinar Jam, but we are going to be switching over to the professional version of Zoom, more of an enterprise version built for businesses. And I think it's going to actually give us a little better dynamics of the presentation for you. So I think we're going to see some good things with that. Yeah. Looks like there's no questions, so
we can move on.
Yeah, I think we're coming to an end here. So we're gonna hit next. Again, we've got a plan. There's a strategy playbook for really virtually every kind of market we have out there. If you want to take a look at these type strategies, you can go to Daniel Krug and Associates YouTube, and in doing so, you can click up very specific strategies that we've gone over in the past that allow you to understand, what is a risk up strategy, what is a draw and let heal strategy, those type things. And we bring them out in a lot of the presentations we've had in the past. So go to the YouTube channel and take a look at all the different presentations we have there. We did break the presentations down. You can either watch the full version, or most of them are broken down into 3 to 5 parts, where you can look at specific areas within the presentation, which is always good when you're looking for the strategies out there to allow you to be able to go directly to them. So that's on the YouTube channel for us, and you can kind of cruise around on there. So that brings us to the end, Rocky.
It does.
So, we say this all the time. There's no need to worry. You take care of your family, and
we will take care of you. We're ready for the future.
All right. You guys have a great day. Enjoy the sunshine outside. Get outdoors, and hopefully we'll be doing that today ourselves sometime.
And hopefully we're talking soon. So good seeing you guys.
Yes.
Have a great day. Bye-bye.